to the extent that stablecoins, for example, become an alternative to bank deposits, can we see deposits leave the system in favor of stablecoins? That's a strategic risk or a strategic threat for the banking system.
Some skeptics of deregulation point out that this may undo years of tightening capital regulations from Dodd-Frank. This could push us closer to a 2008 scenario. In the worst case scenario, walk us through the logic here. Is there a risk of everything being undone in the last 15 years? There are some major key changes in the regulatory environment of the current administration when it comes to the banking sector. We'll examine how these regulatory changes are affecting ratings of banks, the health of the banking sector. We'll take a look at that, and whether or not the banking sector faces any significant challenges or headwinds today in 2025. Christopher Wolfe, Managing Director of Banks at North America at Fitch Ratings, joins us once more. Welcome back to the show, Christopher. Good to see you again.
Thank you, David.
You were on the show in May 2024, so just over a year ago. Let's go over some of the key calls you made last year on my show. Importantly, you said that the banking sector didn't face any imminent threats last year. In a peer review of 13 banks, only one was downgraded, several with negative outlooks. You had preferred larger banks over smaller banks last year. You had correctly called for rates to stay higher for longer, which has played out correctly. And you said that the key differences between last year and 2008 was that 2008 was more about reckless lending and weak underwriting. And last year, the key risks were higher interest rates and post-pandemic adjustments. Mortgage lending was also stricter last year thanks to Dodd-Frank. And importantly, you were expecting last year for more regulations, not fewer regulations. So let's just walk through the changes in the banking sector over the course of the last year and how your ratings have changed, importantly, after the election.
Sure. So our ratings have been fairly stable. And in fact, you're starting to see a little bit more positive development. So we actually have two banks on positive outlook, the regional sector, both Key and Citizens Financial. So I think that's a key change. And the landscape for banking has really shifted very dramatically from last year to this year, post-election. So it's been a big change. And I think especially when you pick up on the regulatory front of things, had we had a Harris administration, we probably would have assumed more regulation coming through. But what you're seeing under the Trump 2.0 is a complete reversal of that. In fact, they're going after a lot of regulations, taking down a lot of things that were put up during the Biden administration. So that's been a sea change. It's really been like a pendulum swing from one to the other. Go ahead.
I was just going to ask, can you please give us a few examples of some of the reversals of regulations that the Trump administration is currently engaged in?
Sure. You can start with crypto is probably the biggest one, where under the Biden administration, crypto was very much disfavored, and under Trump 2.0, it's very much in favor. And you saw that with the Genius Act that was just passed. You also see that with consumer protection. So the CFPB has been, I think, a political football. And so under Biden, a lot of regulations came up through the CFPB, and the Trump administration has been methodically tearing those down. You're also seeing that with prudential regulation. So the capital rules, they were set to get a lot tighter under the Biden administration, and now you're seeing almost a reversal of that. You're seeing that with the supplementary leverage ratio for the big banks. That's being relaxed. So you're seeing that on a lot of different fronts. So consumer protection, crypto, anti-money laundering compliance. You're seeing that with climate risk. Again, the Biden administration very much turned up the volume on climate risk, and the Trump administration is reversing just about everything the Biden administration had done on that front as it relates to banks. So.
Okay, we'll touch on crypto and some of those other key points in just a minute in more detail. I want to read to you, or for the audience, a paragraph that you wrote, you and your team wrote in an article a report rather published in late April called U.S. Banks Regulatory Pendulum is in full swing. And importantly, you wrote that the aim of deregulation is to lower compliance costs, encourage innovation in the financial system, and remove barriers to credit access. Fitch, depending on the finalization and interaction of these efforts, Fitch may view them as broadly negative for bank credit profiles to the extent that they lead to lower capital buffers that are not commensurate with the bank's risk appetite. For banks with less rating headroom, sustained erosion of capital buffers could lead to pressure in ratings. What does that mean? Are you actually more negative on the outlook for ratings given these deregulatory efforts?
Well, what we're trying to say there is banks have actually benefited from having good prudential regulation. Now, to the extent that that is being reversed and allowing for more risk taking to occur, at the same time that capital, the buffer for for losses is potentially being diminished. That combination could lead to a more negative view on on capital. So again, U.S. banks, and one of the reasons they weathered they were able to withstand some of the pressures, during the pandemic was very strong capital bases. And so you are seeing banks increase their dividends, capital, and share repurchases. So to the extent that they're bringing down their capital, that could be a bit concerning.
Well, do these deregulation efforts change the capital reserve ratio requirements at all?
Not at the moment. So, if you take for example the supplementary leverage ratio.
Mm-hmm.
Right now, just bringing that down for the most part, it hasn't been a binding constraint. So there's still, banks are still subject to the risk-based rules. But what we haven't seen yet is whether or not the risk-based rules will get relaxed or not. So that's going to be something we'll see probably either later this year or early next year. So that gets to the Basel III endgame that the Biden administration had proposed and died effectively. But we expect to see something come out of that sometime either later this year or early next. So the answer is we don't know, and I don't think the banks know for sure what the direction of travel is for bank regulatory capital.
What does lower capital buffers mean for consumers and businesses? Are we expecting, or can you expect, more liquidity in the financial system from more lending because of these deregulation efforts?
Yeah, to the extent that you do see some meaningful relaxation of capital standards, it does free up banks to do more lending than they would have been otherwise. And so, and again, you're seeing a lot of lending migrate to the private capital space through the non-bank financial sector. And that's something I think, policymakers are keeping an eye on. And so banks are being, in some ways, less able to lend. And so lowering some of the capital requirements may allow or free up some capital for lending.
Well, is there an appetite or demand for more loans from either businesses and or consumers right now, given the current macro environment?
It's interesting. It's an interesting question because when you look at the loan growth numbers, you're not seeing a lot in kind of just the traditional kind of consumer and commercial, categories. Where you are seeing a lot of lending growth is lending to the non-bank sector. So banks lending to non-banks. That has been growing very dramatically. And it's really, fueling the growth in the private capital space, in private credit.
Okay, interesting. Last year, we had talked about the risks that commercial real estate posed to banks, specifically smaller regional banks, many of whom have had exposure or higher exposure to CRE, I think up to 20 to 30% of the loan books tied to CRE. And that sector posed a risk given the hybridization of work at home and or at the office. How would you assess CRE risk space right now in 2025?
Yeah, I think the CRE risk is really starting to diminish, and it's really starting to be, become more of a rear view issue for the banking sector. So you're starting to see some, I think, probably some bottoming out, at least in the bank CRE portfolios. The problems have already been identified. They've largely been reserved. You still might see some losses come through, so we're not calling an end to the CRE cycle. But what you're starting to see is valuations either bottom out or start to firm up. You're starting to see change in the hybrid work arrangement. So you're seeing more companies require in-office attendance more frequently.
Mm-hmm.
Um, and so you're starting to see some, I think, some positive improvement there, and I think CRE is becoming much less of an issue for the banking sector going forward.
Okay, I know that you and your team haven't made explicit rate outlook projections, but can you maybe comment on maybe stress tests that you've done on whether or not the banking sector faces more or less risk if, let's say, the Fed funds rate stays unchanged for the rest of the year versus a few rate cuts? What does that look like for banks?
Yeah, so right now Fitch is forecasting just one rate cut
Hmm.
in the fourth quarter of this year. So, and we do expect some further rate cuts in 2026. So the direction of travel is likely to see some rate cuts. That's going to be on the short term side. It really comes down to what happens on the long end of the curve. So, just because the Fed cuts short term rates doesn't mean long term rates will come down as well. So, the slope of the yield curve will matter for banks going forward, and we'll see where the Fed policy ends up. I think markets have been expecting some rate cuts, but we'll see when and when they happen. But we do think the banks are be well positioned to manage a down rate trajectory, particularly if it's measured. So 20, if it's a 25 basis point cut here or there, that should be easily manageable for the banking sector. We don't see that as being a stress factor.
Okay, I want to touch on cryptocurrencies now. As you said, one of the major changes in this administration's regulatory profile versus the last is changes to the bank involvement in cryptocurrency. So you wrote that in our view, greater bank involvement raises risks to bank credit profiles, outweighing the potential benefits from financial innovation and growth. Specifically, banks with concentrated exposure to crypto will face the challenges of managing higher price volatility. Absent legislative guardrails, regulatory standards, and stronger industry oversight, Fitch may negatively reassess bank business models and/or risk profiles for banks that are active in the space. Can you elaborate on that?
Yeah, that's key. So, what you are seeing is this administration is very pro crypto, and you saw that with the passage of the Genius Act. So, stable coins are starting to become a more mainstream part of the financial system. And what we're trying to say is, with crypto, you needed some legislation to provide some legitimacy and some guardrails for crypto, and you're starting to see that. You're starting to see some of the regulatory developments. One, taking down some of the prior restrictions on involvement with crypto. But you're starting to see some more, the regulators step up and provide some guidance as to how they're viewing it, and you're starting to see more general, industry oversight. So I think you start to see the crypto industry grow up, if you will. So we do expect stablecoins to be a growing part of the financial system. With that said, it does present strategic risk for banks. So to the extent that stablecoins, for example, become an alternative to bank deposits, can we see deposits leave the system in favor of stablecoins? That's a strategic risk or a strategic threat for the banking system, as we see it.
Concretely, Christopher, what are banks doing differently with crypto now that regulations are changing? Can consumers expect crypto offerings at J.P. Morgan or Bank of America anytime soon?
Yeah, I think banks are still working on it, trying and figuring out what their angle is. You are seeing some of the bigger banks pull together in terms of providing their own alternative stable coin. So you're seeing that with some of the bigger banks or some of the bank service providers. So I think all the banks are trying to figure out how do they approach or attack the stablecoin space, because it's here to stay.
What can you expect as the first step towards crypto adoption from large banks?
You're starting to see some of the bigger banks provide custody services to stablecoin operators, and thinking through, and you're starting to see more tokenization, and that's probably where the real benefit for some banks is really tokenizing assets and deposits. And I expect, we'll see some more of that happening. And that can help with increasing the velocity of cash and payments. So that's one area that we expect to see banks really push ahead on.
What about consumer products? Like when can I expect to on ramp from fiat to cryptos with my existing deposits at a bank?
You're starting to see some of that already. I think JP Morgan has announced some
Hmm.
plans to, some of the banks have announced some plans to work with like a Coinbase or some of the crypto exchanges to make that more feasible. So you're starting to see that already happen.
Have the changes in regulation allowed that fully right now? Like, basically, what is the holdup? Is my question.
I don't think there's I don't think there's a regulatory holdup here.
Okay.
I think some of the regulatory restrictions have been lifted, so I think the banks are now stepping in and testing things and seeing what works and seeing what consumers are looking for.
Well, you highlighted the major risks for this particular sector, and you've noted prior failures like Terra Luna, Celsius, FTX as examples. What can traditional financial institutions, current banks, learn from those examples such that if they were to adopt crypto fully in the near future, we don't have a repeat of that at large banks?
Yeah, I think, the first thing is, and it's one of these things that it's true for a lot of things that you can say about banks, is being over concentrated. So I think some of the banks that also were playing in crypto, such as Signature, um, they were probably a little bit over concentrated in crypto. So when crypto had a problem, they got caught out by it. So I think this is something for the bigger banks, where they can do it as an adjunct to the other things that they're doing. So I think first and foremost, not being overly concentrated in the space, I think is the probably the key for avoiding some of those risks, because those risks will exist. It's just not being overexposed to them.
Have you done any analysis and do you have any thoughts on the emergence of Bitcoin treasury companies? I know those are not technically banks, but a lot of institutional investors are now buying shares or proxies directly into those Bitcoin holding companies. And I wonder how that may impact the banking sector, if at all.
It's probably we have not done any analysis specifically on that, but it's something on our radar, and we're looking
Hmm.
at. You're seeing a lot of these fintechs apply for trust company charters, which it appears some of the regulatory regulators are more open to. So I think we're interested to see how that starts to blend. Fintechs kind of taking on some of the aspects of a bank via these trust charters. But I think it's too early to say just how meaningful that will be.
Do you expect banks, U.S. banks, to adopt some of that role in the future, meaning provide holding instruments for crypto, specifically Bitcoin?
Potentially, I think the thing there is just really the money laundering risks, and I think
Hmm.
that's where the banks will need to tread carefully.
Okay. Any other major risks that the banking sector today faces?
And there are probably more indirect risks, which is really just the fallout from tariffs, and what that means for the economy. So the banks are really just a reflection of the economy. So to the extent tariffs start to eat into economic growth, they're going to feel it that way. And I think the growth of private credit, certainly bears watching. And so, as we discussed earlier, banks are lending very heavily into the private credit space. That's really where a lot of growth is. But does that also present a strategic threat to the banking sector?
Let's talk about profitability. As you know, the yield curve, by most measures, 10-year minus 2-year, for example, has been steepening. What does that mean for the net profit margins of banks, assuming this trend continues?
We think it's going to be beneficial for banks. So, they, tend to borrow short, lend long. So that's going to be, I think, a high, upward sloping yield curve should be somewhat beneficial. We expect
Hmm.
margins to continue to expand probably into next year, irrespective of what, the Fed, will do on short-term rates. So we think this is going to be largely beneficial for the banking sector. So I think it should be a boost to profitability.
Okay. You also wrote a quick commentary recently. U.S. banks to face fewer operating profitability headwinds given recent policy reversals. A lot of that we've already covered. Any other reversals to profitability headwinds that we may not have covered yet?
I think no, but I think it's really on the consumer side, especially
Hmm.
for the credit card lenders, where the CFPB had put up a lot of rules, limits on overdraft and late fees, and a lot of those are not going to occur. So I think those have been those will really help with profitability. Although to be fair, they never actually were implemented, but banks were planning for their implementation. But now that those have largely gone away.
I am curious to get your thoughts on this particular chart by the St. Louis Fed. This is the delinquency rate on credit card loans from all commercial banks. As you can see, the delinquency rate has peaked around Q4 of 2024, and it's stabilized above 3%. Have you done any analysis on what this trend means and whether or not we can see any changes to this trend?
We do some more analyses, and these are the same trends that we've been seeing in a lot of other in our data. It's not surprising to us. We expected losses and delinquencies in credit cards, particularly to kind of peak around this time and then to level off. And if you just, a lot of this is really just a function of unemployment. So I think what happens to unemployment, that's really what's going to drive consumer delinquencies.
So can we make the statement that if tariffs worsen to the extent that layoffs become more imminent, we can expect delinquencies on credit cards to go up? Therefore, banks will have to write off more loans.
That's absolutely correct.
Is that an imminent threat for you and your team?
We don't think it's an imminent threat in the sense that we don't expect that unemployment levels will soar to such levels that losses and delinquencies will be outsized. So we do expect unemployment will tick up. That will certainly drive higher delinquencies and losses in credit cards. But we don't think that's going to be a threat to the banks themselves.
Okay. Some economists have highlighted the risks of tariffs on consumer price inflation, especially on imported goods. Assuming those risks manifest, do they have any direct impact on the health of the financial sector?
Indirectly, I think it's very much an indirect effect, meaning to the extent that borrowers are getting further behind on payments, you'll see that show up in a lot of different ways. But again, we don't anticipate that becoming so pronounced that it has a outsized effect on bank performance.
Okay. Can you comment on the new Basel III rules and how that's going to impact your ratings?
Again, it's the Basel III rules. They were proposed under the Biden administration. They've been shelved, and we're just waiting on what the Fed and FDIC and OCC are going to repropose. So if Michelle Bowman, who is now the vice chair of the Federal Reserve for supervision, she voted against the original proposal that came out. So I think it's in her court to see where this ultimately goes from here. But we expect a more, what we would say, capital neutral proposal, meaning the last proposal would have probably implied an increase of 20% in capital levels. Based on some of the speeches that the governors have made, I think any proposal would probably be more capital neutral, meaning capital ratios probably wouldn't increase, but they probably wouldn't decrease much.
Generally speaking, have you noticed significant changes in the products offered at commercial banks given the changes in the administration post-election?
I haven't noticed any changes in product offerings as it relates to kind of the change in administration. No.
Investment banking attitudes, any changes there?
You're seeing, I think investment banking was expected to be a bright spot following the election. And then with the tariff announcements and all the market volatility that ensued, a lot of the investment banking hopes, were kind of put on pause. We're starting to see that pick up now that there's, I think, a little bit more clarity on where tariffs are headed. Where you have seen strength is on the trading side. I mean, all the volatility in the markets was actually beneficial, especially for the large banks. They really benefited quite nicely from that. And markets, function very orderly despite the heightened volatility over that short span of time.
Have there been any changes, though, in terms of how banks are competing for deposits, especially small versus large banks?
No, I think banks, deposit competition remains intense. So I don't think there's anything new or different on the horizon on that front. But I think that's been Everyone has, I think, seen the value of having some insured deposits on their balance sheet and not being too reliant on uninsured deposits.
From a financial health and positioning standpoint, which sector do you favor right now in terms of ratings? When it comes to ratings, rather small versus large.
I think the large banks, especially the G-SIBs, are very well positioned from a rating standpoint, and they've been benefiting quite nicely from their franchises. I think for the when you get to the regional banks on down, they're in good shape, but there's also going to be a lot of M&A that will take place, and so I think that can complicate what the financial picture for banks will look like. You're starting to see some big announcements come out. So I think we expect quite a bit more to occur.
Okay, I'm curious to see your analysis on this chart. This is the DXY, the dollar index. It's been sliding all year for a variety of reasons, tariffs included, and the trade war included. I wonder if this sliding of the dollar and weakening of the dollar is going to have any material impact on the financial positioning of banks that hold significant FX reserves.
Not really. I think it's really more of a big bank issue, and someone like a
Hmm.
city, which is very global in nature,
Hmm.
might see a little bit more noise in their financials as a result of currency movements. But I think when you get to kind of most of the regional banks on down, it really doesn't have an effect on them at all.
Okay, so then looking ahead, any major developments, news items, or political events that you're watching for that may change ratings for you?
Nothing specific that will have a direct and immediate effect on ratings, but watching the private credit space, watching what's happening on stablecoins, and seeing where those go, watching for where more regulatory policy changes are expected. Those are probably the things that we're watching the most, and obviously the economy in terms of rates and policy and tariffs. But I think we're starting to see some certainty around that. So I think it really comes down to stablecoins, private credit are probably the two more interesting things that could have some impact.
I want to get your reaction to this. Professor Richard Werner was recently on the Tucker Carlson show, and part of the segment touched on how banks create credit and money. To his point, and we can play a clip for the audience later, he says that credit is literally produced out of thin air. I think he was talking about the money multiplier effect and how the fractional reserve banking system allows banks to create more money than the deposits actually made.
So when it did the empirical test, the conclusion was the financial intermediation theory is rejected and the fractional reserve theory is rejected. Banks create money out of nothing. By the way, you can look it up. It's the most downloaded paper of all Elsevier publications and it's open access. So can banks individually create money out of nothing?
Any bank.
Any
Not
bank.
just, to be clear, not just central banks,
Any bank. In fact, that's the whole point. We're talking about normal banks. With central banks, it wouldn't be a surprise.
but the Bank of Omaha can
Yes,
just.
any bank creates money. When you take out a loan, the money that you're given as the borrower didn't previously exist. It is net new purchasing power that is being created and added to the money supply. And that's how the system works. Now, to understand how the system works is a precondition for having good economic analysis and good policy recommendations. And that explains for over 100 years, macroeconomics has made no progress. They have no banks in there. They have no bank credit creation in there. When the 2008 crisis happened, and the journalists, and I'm sure yourself also, want to ask some experts. Let's go to MIT professor of economics. What's going on? Lehman Brothers gone bust. Banks are going bust. Bank of America in trouble. What's happening? The honest answer of all the professors of economics would have been, well, I'm sorry, I can't answer that question.
Can you just comment on this further and just shed some light into how this may work? I mean, if banks create money out of thin air, why isn't everybody a millionaire already?
Yeah, it's always a very good question. But that's what banks do. I mean,
Yeah.
banks do create credit, and they've been the primary creators of credit. So I think what will be interesting is when you start getting into these cryptocurrencies and in things that are called narrow banking, and you're getting away from fractional reserve banking. That's going to be, I think, a real interesting thing as to how that develops, how or whether it develops. But the banks have been the engine of credit creation for the dawn, since banks have existed, and so they are a core function of the economy. And to the extent that you put something else in, you try to replace them, or there's some kind of substitute, That's where I think you really need to pay attention, and policymakers really need to understand the implications of that.
Do you think that the adoption or the further adoption of stablecoins is going to significantly change the money supply, the M2 money supply in any way?
I don't know that it'll change the M2 money supply in and of itself, but it may change the form of that, and it may change where it exists. So is it on a bank balance sheet, or is it in some kind of fund controlled by some non-bank entity?
Scott Bessent, Treasury Secretary Scott Bessent, has been very vocal about why it's important for the government to push towards the adoption of stablecoins. I'm going to share with you this quote that was recently posted on the Department of Treasury website. Statement from the Secretary of Treasury, dated July 18th. Secretary of the Treasury Scott Bessent issued the following statement following the signing of the Genius Act. Stablecoins represent a revolution in digital finance. The dollar now has internet-native payment rail that is fast, frictionless, and free of middlemen. This groundbreaking technology will buttress the dollar's status as a global reserve currency, expand access to the dollar economy for billions across the globe, and lead to a surge in demand for U.S. treasuries. Before we continue with any further, do you agree or disagree so far with this statement?
I think it still remains to be seen. So I think stablecoins have that potential. I think the impetus is to solidify the dollar as a reserve currency. So I think that's the thrust of why the Genius Act, behind the Genius Act. I think the question is, does it ultimately, serve that purpose? I don't think we know for sure at this point. But there are some things that you could see coming out of this, which is again faster payments, especially cross-border payments. Faster velocity of cash. So that could make the dollar more attractive vis-a-vis versus other currencies, if that's the case. So I think the potential exists. I don't think we know the answer for sure.
Well, for the average person watching the show, the average consumer who's not a banker or working the crypto space, why should we care about the adoption of stablecoins? In other words, how would our lives change if more of the B2B or even B2C payments are made via the blockchain?
Well, it does matter because in terms of how things, what happens when things go wrong. And that's the thing that we don't know. So, again, take your bank, you have a loan. Let's say you need some forgiveness or some kind of some help. The bank might be able to restructure your loan and do something for you. On a blockchain or in kind of like those things are harder to do potentially, or at least we haven't seen how those things would work if that happens. So I think there's just a difference in terms of how the mechanisms, what happens when things go wrong, who's responsible. So I think there isn't, who's that responsible party? Who's that trusted entity that will make sure things work?
Okay. And final question before we go, Christopher. So some skeptics of deregulation point out that this may undo years of tightening capital regulations from Dodd-Frank. This could push us closer to a 2008 scenario. In the worst case scenario, walk us through the logic here. Is there a risk of everything being undone in the last 15 years?
Yeah, I think that's the premise of what we're terming this pendulum swing, which is, the regulatory sphere keeps going from tightening to loosening, and they need to find a happy medium because regulations that are too tight are almost as bad as regulations that are too loose. So you want to create the right incentives. You want to give banks the ability to conduct their business in an economical way. So if you make capital rules so high that banks can't really serve their purpose, that's not good. But if you make the capital rules too loose, as happened, in the lead up to the 2008 GFC, then the banks become undercapitalized for the risk that they're taking. So I think, the problem that everyone, that the regulators need to solve for is to find a happy medium on that front because the extremes on either side are not good.
So I know the roadmap remains to be seen, but so far from what you've seen since the inauguration in January, have we witnessed dramatic changes to the risk profiles of banks such that we are on the road back to a 2008 scenario?
We've not seen that, no. So you're
Okay.
starting to see, I think, some of the regulations kind of go back to where things were, say, around 2020. Just prior to the Biden administration. So you're seeing that, but we've not seen, I think, any a buildup of risk as a result of of the election.
Great. Well, thank you very much, Christopher, for your update.
All
And
right.
where can we go to follow your work and Fitch Ratings work?
www.fitchratings.com, and you can find our research there.
All right. We'll put the link down below. Thank you very much again. We'll speak again soon. Take care for now.
All right, thank you.
Thank you for watching. Don't forget to like and subscribe.